Stronger than expected inflation in the UK pushes out rate cut bets as Rishi Sunak calls a snap election. New Zealand's Reserve Bank turns hawkish and pushes out rate cuts. Indonesia holds rates, while Singapore's core inflation is expected to rise. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodity Strategist Daniel Hynes looks ahead to a key meeting of global oil producers and what it could mean for supply and oil prices.
The meeting between OPEC and its allies, such as Russia, on the 1st of June is the key event in the oil market in the shorter term. There's certainly 3 main scenarios we see playing out.
But first, in 5 and 5 with ANZ. Stronger than expected inflation in the UK has seen traders push out bets on when the Bank of England will start cutting rates. The annual headline CPI dropped from 3.2 to 2.3% in April, led by falls in goods and energy prices, but this was a smaller drop than expected, as services inflation remained stubbornly high at 5.9%. In the US, Treasury yields were up 1 to 4 basis points by 4 a.m. Sydney-Melbourne time, ahead of the Federal Reserve May meeting minutes due this morning. Gold was down 1.4%. The Aussie dollar down 0.5%, at 66.31 US cents, while the Kiwi was up 0.2% at 61.02. It was the UK where attention was focused overnight, including on Prime Minister Rishi Sunak calling a snap general election for July 4. Here's ANZ economist Bansi Madhavani on the reaction to those CPI numbers, which drove the FTSE 100 down 0.5%.
Prior to the data release, markets were pricing June rate cut possibility at 50%. And had fully priced in a rate cut in August. But after the data release, the bets have shifted dramatically, with chances of June rate cut down to 10% and the first rate cut now fully priced in for November. We maintain our base case that the Bank of England will be in a position to cut rates in the third quarter, but we acknowledge that data needs to confirm progress and that risks are now skewed towards a later start.
Number 2, the Kiwi dollar was buoyed by a hawkish turn by the Reserve Bank of New Zealand. It held rates at 5.5% yesterday as expected, but pushed out its first forecast rate cut by 3 months to August 2025. Here's ANZ New Zealand Chief Economist Sharon Zollner.
This is old school inflation targeting. So their focus was very much on the fact that the non-tradable inflation, the domestic inflation, has fallen much more slowly than they expected, and that possibly that means that the speed limit of the economy is less than they thought. So even though they have revised down their growth forecasts, they've actually revised up their estimate of the capacity stretch in the economy, which is what drives inflation. So we actually saw quite an upgrade to their inflation forecasts. They now don't see inflation back at 2% until mid-2026. We've stayed with May next year for cuts, and we would see the risks tilted that indeed they do end up cutting earlier than that. But today was certainly a shot across the bows for a market that's been keen to price a decent chance of cuts as soon as August this year.
Number 3, South Korea is expected to hold rates at 3.5% today. Meanwhile, Bank Indonesia held at 6.25% yesterday. ANZ economist Crystal Tan says the central bank indicated its rate hike in April was enough to support the rupiah.
Going forward, Bank Indonesia continued to anticipate a 25 basis point cut in the Fed funds rates this year and also signaled a data-dependent approach in terms of policy direction. For our part, we think that the hurdle for another rate hike by BI is high, but at the same time, it cannot reverse course until the US Fed pivots.
Number 4, global PMIs released today will feed into bets on where interest rates are headed. ANZ FX analyst Felix Ryan says the surveys can be good leading indicators for major economic data.
For instance, in the US, PMIs can be a useful lead indicator for things like employment and general activity overall. The US PMI preliminary data we had in April was maybe some of the earliest indications we had, or more significant indications we had of fading US economic exceptionalism that we've seen come up more prominently in employment data and activity data since then.
Number 5, Singapore releases April CPI and final Q1 GDP data today. ANZ Head of Asia Research, Koon Goh, says annual GDP looks set to stay steady from the advance estimate at 2.7%, but core CPI, which is the focus for monetary policy, looks set to rise to 3.2%.
Core inflation is still somewhat elevated, but there are a few one-offs that had pushed the number higher, which I expect to unwind. For example, there had been increases in water prices, which will not be repeated again.
Couldn't go there. Now, in part 2 of our bonus deep dive interview on the oil market, ANZ Senior Commodities Strategist Daniel Hynes looks at oil supply as an important meeting between oil producers on the 1st of June approaches.
The OPEC voluntary cuts have gone a huge way to keeping the market relatively tight. And look, the meeting between OPEC and its allies, such as Russia, on the 1st of June is the key event in the oil market in the shorter term. There's certainly 3 main scenarios we see playing out. They could potentially extend those voluntary cuts, which were supposed to end at the end of June. They could gradually reduce those voluntary cuts over the course of the year, or they could completely unwind them in July. Now, that last option, we suspect if it occurred, we could actually see prices fall quite sharply and maybe end up in the mid to low 70s. But if they do extend the voluntary cuts to the end of the year, we're going to see a pretty tight market. And I suspect with that improving sort of economic backdrop and then tailwinds from the macro environment, such as potentially rate cuts by the Fed and a weaker dollar, we could see oil in the mid to high 90s, even $100 a barrel. So, that the wide range of price scenarios, based off that OPEC meeting means it's going to be something which the market's going to be watching pretty closely.
So could you talk about US shale production growth and how it's falling off?
Yeah, in fact, we saw another week of sharp decline in oil drilling activity in the US, particularly in the shale regions. And that's now at a point where it's insufficient to replace the wells that are drying up. So ultimately, oil production in the US is going to suffer as a consequence unless they pick up drilling pretty soon. And that can take a little while to reverse. So I do think that the lack of growth in supply from the US is going to be another contributing factor to a tight market in the second half of the year.
Is anyone looking to step up into those gaps?
Oh, look, there's growth coming elsewhere, in small little amounts. So that will contribute some. But ultimately, OPEC holds all the cards here. And that's why that meeting on the 1st of June is so important. They have about 6.5 million barrels a day of spare capacity that they're holding off the market. So if things do get tight and prices start to rally quite sharply, then OPEC has the option to step in and provide some supply. And I think ultimately that's a reason why prices won't be back at $120 or $130 a barrel anytime soon. They can supply the market with plenty of oil if either demand rises quite strongly or if we do see a significant supply disruption to the market.
So it seems like geopolitics is driving the oil price less and less at the moment, even though there's still a war in the Middle East and one in Ukraine.
Yeah, no, certainly that geopolitical risk premium has been reduced quite significantly, although I'd hazard to say, the risks are still hovering over the market. I mean, the death of the Iranian president suggests there could be a bit of a political vacuum there in one of the key oil producers in the region. And we've seen, obviously, attacks by both Russia and Ukraine on their energy infrastructure over the past few weeks as well. So there are still issues bubbling away in the background, but certainly a real threat to oil supply has diminished, I suppose, as those tensions have eased in that Israel-Hamas war.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, May the 23rd. Catch you tomorrow with the details from the global PMIs. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.